There we go. Welcome, everybody. We have a Lunch and Learn webinar today with Denise Piazza from One Street Capital, who came on to share information with us. Denise, we appreciate you coming on. Welcome to the Left Field community.
Thank you so much. Happy to be here.
Great. I am going to go ahead and put your presentation up and we'll let you get started. Get into share. And let me put it in presentation mode and then let me know if that's coming through okay.
Yes.
Does that look all right?
Sounds great. Yep. If you can jump on over to the first slide, that would be great.
And I'm sorry, real quick, just to let people know, if you have any questions, feel free to drop them in the Q&A. And we'll get to those as we go through the presentation. But Denise, again, welcome. Take it away.
Thank you. Okay. Well, thank you everyone for joining. Really appreciate sincerely taking time out of your day to be here. I think a lot of us are here because we've invested in real estate or we are interested in investing in real estate if you haven't pulled the trigger yet. A lot of us probably know that it's a great way to diversify your portfolio, can act as a good hedge against inflation, and just in general has multiple tax advantages compared to some other investment vehicles. Based on my conversations with Jim and others in this group, though, I know this community has a really strong knowledge of real estate investing, and I think it's great to really lean in to others and their experiences. But as investors, my opinion is that we should all continuously be learning. So I'm here today to talk more about how we can feel more comfortable. And I've, over the years, grown that comfort level that we're investing intelligently in real estate offerings and how to just do some better due diligence when you're investing passively. And just before we get started and dive in, just a quick background on me. I began working with real estate over 20 years ago with several clients with real estate investments while I was working at an accounting firm. While preparing a lot of returns for some of my highest net worth clients, I noticed that one of the common denominators across their portfolio was real estate. And I knew it was something that I wanted to have within my portfolio. Fast forward a few years later, my husband and I, who are actually both CPAs, which basically just means that if anyone ever has any problems falling asleep, you can give us a call and we can tell you all about our day. But we began investing together across multiple asset classes. We really tapped into our network of clients who had a lot of real estate investments experience. Some were developers, others were operators. And we did so that we could just increase our overall knowledge and just like this community does, tap into one another for sharing experiences. I think it certainly helped us along our path, but some things you really, in my opinion, you just have to learn for yourself. When we were investing, we bought single family office space, invested in triple nets, retail and multifamily. And more recently, I've been focused in my company on multifamily investing. What I didn't appreciate, though, really to the extent that I did it, or that I do compared to that, those first few investments, is just how to do the right level of due diligence and what it means to properly evaluate some offerings. I learned after a few investments, I guess, how to do a better job of that and just feel as though I'm better able to mitigate risk. So today I'd just like to share some of these steps and things that I learned along the way in my passive investing experience, in hopes that it helps you avoid some of the mistakes that I made, especially early on. And then Chad, if you don't mind jumping over to the next slide. But here's my checklist, just a very high level checklist of some key steps to take in order to help improve your success rate when you're investing passively. Find ways to increase that know, like, and trust factor before you invest with a group. And I know this can be extremely difficult because, you might not be personal acquaintances with the individuals that you're investing with, but there are some things you can do. You can schedule time with one of the partners to ask them some various questions that we're about to discuss, ask them for referrals and or sample investor communications they send. And I think it's pretty surprising how few people actually ask for investor referrals. I know you can assume that they would probably give you a positive referral, but if you ask the right questions, I still think, that things can come up in that referral process. And I think it's an important step to take. I do think this know, like, and trust factor is one of the most difficult to obtain, but with communities like LFI being such a good place to obtain referrals, I think you're already a step ahead of the game. And it doesn't necessarily, obviously, eliminate your investment risk, but it's a better way to just reduce that overall investment risk. And one thing we're going to talk a little bit about today is, looking for those strong market fundamentals when you're investing. We're looking at asking the right questions, doing some due diligence on the investments and the overall team. And the last thing that I want to just, it might sound a little bit strange, but is don't just simply rely on someone's track record, their previous success, meaning how they performed on prior investments or what, others in the industry across all the asset classes refer to as their overall, company track record. And the reason why I say is to not simply rely on this is because over the last decade or so, it's been a heck of a lot easier to show great returns on investments, as many of you probably know. The market was extremely hot with interest rates being at historical lows, and the demand incredibly high for many asset classes. So should you ask for a team's track record or, the group's track record? Absolutely. But my point is you just don't want to take that at face value and not do any other additional steps to really get to know the opportunity that you're about to invest in. Next slide, please, Chad. The three pillars, once you know, I guess, what asset class you want to invest in, the next thing you want to understand is, is it a good deal? Is it a good opportunity? I've invested in multiple properties and many different asset classes, and I've had great experiences and some not so good experiences. But based on all of these investments, I analyze three different pillars to consider in any opportunity. And one is the market that you're investing in. Investing in the right markets, the right locations can greatly reduce your overall investment risk. And we'll jump into that a little bit next for what to look for in the market. The second item is the deal itself and the financial data. I've come up with some red flags to be on the lookout for when reviewing financial data. I'm a former auditor by trade, so I use the concept of trust but verify. Even, for my own investments, we spend a lot of time and thousands of dollars investing in third-party software to have, real data backing up the assumptions that we're using. And lastly is just the teams that's actually operating the asset. And this is one that I think gets overlooked so often, but it's critical to the success of being able to execute the business plan of whatever real estate investment opportunity you're investing in. A great team can turn just an average deal into a home run. And on the contrary, a bad team can turn a great asset into a dud. So when you're purchasing an asset, you just think of it like you're buying a business. And you need people that can effectively execute that business plan. And if you can jump to the next slide, please. These are some of the key factors that, I look for, and I know many others probably in this community have heard some of these factors in analyzing investments before. But, again, back to reducing your overall investment risk. When you're investing in a market that meets criteria related to these various factors, it really reduces that overall investment risk, because if you're investing in an area where there's population growth, there's job growth, that there's a lot of diversity across the multiple employment industries, it's obviously going to increase that natural appreciation that takes place in a market. So, we have a number of metrics that we use in order to figure out where, what levels of population growth and job growth, and the schools and the crime rates in a particular area before we invest. One thing that I did want to, share with the group is that there are a number, if you don't already know, there's a number of free tools available to help you learn more about these metrics. So you might want to write these down in case you're not already aware of some of these, but some of the free tools that are available are niche.com. You can look at the places to live there, and that will rank all of these different factors other than landlord or tenant friendly, but it talks about your, the wage, the average household income, the population in the area, the amount of renters versus homeowners. And it also rates schools and has some crime ratings as well. There's the U.S. Census Bureau, which obviously can speak to the unemployment rate in certain areas. The Labor Bureau, which will talk to job growth in a particular area. Bestplaces.net is always a good one for crime, schools, and housing factors. And one that I use is Neighborhood Scout. In addition to having, multiple boots on the ground in these markets where I'm the active operator. But, Neighborhood Scout is one that it isn't free, but I believe it's pretty reasonable if you were only looking at a few locations throughout the year. I have the full subscription because of the number of deals that we review on a monthly basis, but Neighborhood Scout is great in that it really dives into some of these metrics that are on this slide. Next slide, please, Chad. Okay, so let's assume you're looking for a real estate property in a growth-oriented market, one with a history of appreciation, low property taxes, and a growing economy. Because the team that you're investing with has done a lot of research, they should be able to tell you why they're investing in a particular area, in a particular property, in a particular market, and make sure they present, these real numbers to support their choice. Some stats that they should include are job growth, median household income, to ensure that for me, especially focusing on multifamily, there's the key criteria of median household income to ensure that folks can afford the rental rates that you expect to be charging based on your pro forma. Population growth. And if this type of information isn't included in the presentation deck, I want to ask some questions about these factors in the market. And I want to know, if there's if their tenant base is going to be geared towards families, is it in a good school districts? What's the overall crime rate? And again, all of these factors are going to greatly increase the value of the property. People are going to want to invest in that property in the future. And it will, just overall reduce that investment risk that I've been mentioning. You should also ask about other projects that they have nearby and how those properties could affect, how ongoing property new builds within that submarket could affect the returns that they're pursuing. So that's just the absorption factor that speaks to the supply and demand in a particular market. You want to ensure how much new supply is going to be coming and how that will impact the market's absorption of new supply of properties. If a market is oversupplied without demand, it will certainly have an impact on your financial assumptions that you're using for the deal. Next slide, please. And the next key component, and one that just, being very honest, that I would really focus on when I was in my early investing days is, being the CPA, I would jump right to the financial projections. So I would say, okay, well, what am I going to make? What are my returns going to look like? But one thing that I came to realize is that investment opportunities can vary widely. And you should know as many details as you can before you sign any paperwork. The most obvious questions should be presented with the deal and should be answered out front, like how much capital you should invest, what's the potential cash flow and the overall returns, how long the expected hold time of the asset is. And you want to move beyond the outline of the deal itself, and how long they expect to hold the asset, and things like how often payouts are distributed, and what the sponsors will do if the market happens to soften near the end of the deal, or the time where you plan on refinancing, or if interest rates have risen in the extremely quickly fashion that they have recently. And one question I've been asked by other sponsors in the past is, what if your business plan hasn't gone to doesn't go to plan? How do you pivot, and how have you pivoted in the past? And people with the right level of experience should be able to speak to that. And again, in my many days of being an auditor, we have this concept of trust but verify. So when I'm looking at an opportunity, I want to make sure I'm comfortable with a few key financial components of the deal. And the first of which, and to me that's most important, is the debt structure. So how much debt are they using? I think newer investors can often, they only review the return structure, but the reality is that most of the riskiest assets and investments in real estate are those with just too much debt. It increases the odds of an owner losing a property. And again, I'm largely focused on multifamily investments, which are historically more recession resilient asset classes, but you want to make sure any asset you invest in is not over leveraged, just has too much debt. Another item to make sure that you review is the preferred return. And the preferred return is ensuring that the lead operating team does not get paid until that preferred return is met. So for example, if an investment opportunity has a 10% preferred return, they get paid nothing until that return is reached. And it just, in my opinion, helps align the interests with the investors, so that the preferred distributions, so that the investors get paid, the preferred distributions, so the operator will not get paid anything until that minimum return has been obtained. And lastly, you want to review some of the key assumptions and make sure there was some thought put behind them. And I think I mentioned earlier, I often like to see third-party support for some of these key assumptions. So in the case of multifamily, some of the key assumptions that are being made in the pro forma are your rent projections, and then the exit cap rate, which is basically just your projected valuation at the time of sale. You want to look for, like I said, some third-party support behind these assumptions. We use, personally, I use third-party software like CoStar and Yardi Matrix, so that we can have this support behind the basis for our projections, and it helps with being able to perform some stress testing as well. And just as an overall statement, if the financial assumptions are too aggressive or unrealistic, it essentially takes the financial projections that you're seeing with an investment, it makes them completely not realistic. And the reality is, could it still be a decent return? Sure, but you're relying on things more like cap rate compression, or relying on the market being really hot, and you won't be optimizing your investment dollars and your hard-earned capital, and not doing the full due diligence and mitigating your risk with these investments. And Chad, if you could just jump to the next slide for me. So these are a few questions that I have posed for the group that you can make sure that you're addressing when you're reviewing and investment opportunities. So like I mentioned, one of the key components that I look at first is what is the debt structure on the deal, the loan to property value percentage, or the LTV. What's your interest rate, especially important in this environment right now. I know a lot of teams that are only focused on fixed rate debt right now because of the volatility in the market. And liquidity is, so how long will it take to get your initial investment back, and what's the overall business plan in order to do so? You want to look at the return metrics, like the preferred return and does it accrue? So meaning if it's a value add opportunity and they don't meet the preferred return in year one because you're stabilizing an asset, does that return accrue to the following year? What is the expected internal rate on return and cash on cash? And then what are the return splits between the general partner and limited partner? Are there investment hurdles? So once they reach a certain return threshold, does the split between profit allocation to general partners and limited partners, does that change? And these are all just things that you want to make sure align with other deals that you've seen in the LFI community and with industry standards, basically. And then lastly, it's those key assumptions that are behind the pro forma that you're being shown that I really think can make or break the deal. So that's the rent projections. Are they reasonable? What is their projection for the valuation at the end of the hold period or refinance period? And then have you stress tested the investments with different rent growth factors, different exit cap rates and things of that nature, and have them show you the stress tests that have been performed. You often see those in the presentation deck, but if not, make sure you ask about them. Next slide, Chad. And then just the final area that I wanted to touch on is the team and asking the right questions about how they operate their assets and how they perform. So generally, I think the management team's credentials are some of the most overlooked aspects. The personalities get lost in the paperwork and research, but make no mistake, to me, the team is the most important part of real estate investing. And I think that's one of the key lessons I took away from my early years of passive investing. So find out the experience your sponsors have had in real estate and how they've dealt with adversity. Ensure they have the right team behind them, proper attorneys, brokers, CPAs, and don't be afraid to ask for investor references like we mentioned, or do a background check. Another area to ask about is the metrics they use to track their property's performance. So the actual asset management of the property is so critical and is what sets apart, in my opinion, the good teams from the bad teams. There are KPIs or key performance indicators that an operator should have. I've been more focused on multifamily, as I mentioned. So we look at leading KPI indicators and lagging KPI indicators when it comes to leasing, financials, work orders, and things of that nature. I want to ask them how they analyze the financial results on their properties. So one thing that I like to see is that someone's comparing their actual results to their budgeted results, and that they are really digging into those variances. So for example, on one of my properties, that when we were reviewing the March financials, I basically review every week all of the cash transactions that go out on a daily basis, because I want the team to know that I'm watching and that I'm paying attention to everything that takes place. And so one of my questions that was asked to the team was about a $225 invoice. Now, in the grand scheme of things, is that invoice going to make or break our deal? Absolutely not. But I want them to know that I am always, interested in seeing the quality of things that we're purchasing, and also explaining to them how the expenses and the revenue that we're bringing in ultimately have that impact on the exit valuation of our property. So your property's value is all driven by your net operating income or your revenue less your expenses. So you want to be extremely aware of how they manage that asset and manage reviewing their financials, because what I've found from working from different teams is that, you know, some groups don't necessarily dig in onto those types of variances, and that's how you get, you know, sort of misaligned between what, you know, the original pro forma was in your presentation to your investors and what the actual results are. So you want to make sure that you're working with a team who's very detail oriented and wanting to dive into those types of financial analysis. And I have listed on here a few other key questions that you can consider. You know, real estate to me is just like any other business. The best teams usually create the best outcomes. And so you want to make sure you're investing with a management team with experience and that one that's prepared for any changes in the market. Next slide, please, Chad. So this is just, this is my team who I work with. Like I said, my husband and I are both CPAs. So our, you know, we have many different jokes about it, but basically the other joke we have is that our kids have no chance of whatsoever of being cool. But, you know, we took all of the experiences we had with these investments, and we focus on providing our investor community with opportunities to invest with us, alongside us, with, you know, assets that we feel meet our stringent investing criteria. And then, you know, fast forward to today, we do have over 900 units in assets under management, and have just participated in hundreds of millions of dollars of transactions as limited partners as well. And just in summary on my last slide, Chad, just hopefully some of these questions have sparked some new ideas or just some different ways of thinking about potential investment opportunities and deal sponsors. When you're looking at prospective investments, I just think no question is off limit. And if someone's trying to, you know, dismiss your question or not answering it thoroughly, I think that's a key indicator as to how, you know, the communication will go in the future with the deal. You should really feel comfortable with private real estate investment, you know, opportunity and the sponsor before you sign off on the offering memorandum. And it's likely that, you know, the financial returns are what initially attracted you to the deal. So before you jump in, just take your time to properly vet the opportunity and the deal sponsor. I think it makes, you know, overall this industry even stronger. We should have investors across the industry that are more knowledgeable, because it can only bring more success to the overall industry. You know, especially in the market that we're in today with all of the risk across, you know, many different investment portfolios. I think, you know, it's important for teams to want to educate their investor base. Focus on the things that might not be so clearly written on the paper, like relationships, personalities, and integrity, so that you can feel more confident that you're investing with a good team. And with that, I just have my contact information on this last slide. And, you know, Chad, the one thing that I can do is drop, we have a resource on our website, and I can either put the specific link on the site or on the chat, but if you just go to onestreetcapital.com, you can download the 50 questions for free. It's just something that, you know, that we've developed and used over the last, you know, few years.
Yeah, no, I think it's great information. There's a lot of stuff it's good to see again, because we kind of, if we've been doing this for a while, we kind of get in our lull. So it's good to get a refresh, but great information for those that are newer. We've got a lot of newer people in our community too. So it's great to see it in this kind of format that can help people really think through how they ought to be approaching some of these deals and so forth. So thank you for this today.
Sure. No problem. And one thing I always offer to people is, if especially if you're first starting out, even obviously if it's not with us, it doesn't need to be with us. Please feel free to reach out. Like I said, I really like to think that my husband and I want to take the knowledge that almost the mistakes that we made in the beginning and jumping in a little too early into a deal and help, help others with sharing that knowledge. And I truly believe that a more educated investor base across this entire real estate industry is only going to improve the industry in general and improve returns for all operators, all, asset holders, and we'll just, continue to strengthen our industry.
Yeah, that's great. No, I would agree with that. I think that's very fair. Again, any questions that anybody has, feel free to drop them in the Q&A and bring anything up. I'll ask a personal question almost. Do you guys still do CPA work, or are you strictly over?
My husband does.
Does he still?
My husband, yes. If I took this background off that I have, you would actually see like tax returns hanging from the ceiling in this room that I'm in. So
this time of year,
office,
that's so weird.
Yeah, exactly. So his office that I'm in right now is filled with paperwork. But yeah, it's a crazy time of year. He has his own firm, and we've like I said, had a great community to tap in through both of our various clients that we've had. But yeah, it's a crazy time of year.
Right. Yeah. Well, that's why we call it the tax season anytime we're busy, right? So
exactly.
You guys, you definitely felt the pressure of all that.
Mm-hmm.
Again, well, we won't stutter out. Oh, here comes a question. Good. How would one find out about your investment opportunities? So how can they track you down? I guess it's this information probably. But.
Sure. If you go to onestreetcapital.com and click join, we will add you to our investor database, and we will share any investment opportunities that we have with that whole community, and provide all the details, like we discussed today. We do, a handful of deals a year, not many, because as you can imagine, we have some stringent investing criteria, and that we will not stray from. So, but when we do find one, we get extremely excited over. And yeah, if you go to onestreetcapital.com, you can not only, or you don't even necessarily, even if you just want to do our 50 questions article as well, you can also download that. There will be an automatic pop-up that shows up that allows you to download it. But there's also a button to push to join our investing community.
Cool. Good. Well, by all means, if people do have questions that they don't want to bring up here or want to reach out, get a hold of the contact info. We'll be sending this out to the entire community, so everybody will get a chance to take a peek and reach out if they have questions. But Denise, again, really appreciate you coming on and supporting Left Field today and sharing some knowledge. Like a lot of great tidbits in there. Again, I don't think your tidbits, the things you shared, could be overshared. So I'm really glad you came on and went through a lot of this stuff with us today. Good stuff. Oh, here's a question that popped up. What should we watch for with fees?
Yeah, Heather, I think that's an important one. I mean, I try to look for what the industry standard is. And to me, industry standard for fees when it comes to multifamily investments, I can speak most, I guess strongly about, is there's typically an acquisition fee, which can range from 1% to 2%. There's the asset management fee, which we've typically seen around 2%. And then an exit fee when the property is refinanced or sold, which I believe industry standard is somewhere around 1%. So you just, when you're reviewing the fees, and they're typically disclosed in the investment presentation, and if they're not, you should certainly ask about it. My goal is to always ensure that it aligns with what the industry standard is, and that no one's being egregious and how much you're charging. Because the reality is there is a lot of work that goes into, especially with people that are doing the right level of due diligence on their properties, and on an ongoing basis, keeping up with hiring individuals to do that asset management work, whether they're vertically integrated or they have multiple asset managers working with them. That really is how you want to make sure that they're keeping up with all of the acquisitions that they've done, and that they're able to properly analyze the results for all of their properties.
No, I think that's great. We often coach, if you do see a metric that's out of alignment with the industry, gives you a good opportunity to vet this operator more, because you
Yeah.
should reach out to them and ask them about it and see how they
Absolutely.
respond. And that'll give you multiple answers then maybe of how they perform and what their underwriting's like and so forth too. So
Sure.
good stuff.
All right.
Well, great. Denise, again, thank you for coming on today, and we appreciate the support. And if anybody has any questions, you can reach out directly and get a hold of them. But thank you for your time today.
Thank you, everyone. Appreciate it. And Chad, have a great vacation next week.
Thank you. I
Enjoy.
appreciate that.
All
Absolutely.
right.
All
Have a
right.
good one. All
Take
right.
care.
Bye-bye.
Bye-bye.